Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we're back on YouTube and it's time to have a look at Bitcoin. Now, first things first, there's a video on my channel called the Bitcoin Primer. There will be a link in the description box below. If you're new to my channel or you're new to Bitcoin in any way, please go and watch that first. It will bring you up to speed on everything you need to know about my opinions, essentially. I cover in that my long-term view on Bitcoin. I cover the long-term 4-year cycle. I cover the halvings. I cover the bear markets, the bull markets, the long-term Elliott wave count, and my projections for the future. It's all there. I suggest you go and watch that first because these update videos are going to be focused on the shorter term and the options we have over the shorter term of how we can interpret the count. Okay, so I am, however, going to start by just spending a couple of minutes looking at the longer term, not the full long-term count, but the longer term. And I just want to share with you this lovely piece of geometry, which is a pitchfork we have based off of cycle wave degree. And this has been proving ever since the pivot back in 2017 to 19 bear market, the cycle wave degree, an extremely good predictor of where price will go. And as you can see, putting things super simply, we tend to reach the median line, back test the median line, test the highs of the pitchfork, back test the median line, and we can do that at various wave degrees. We're either looking for the median line as a completion target before we come lower, or we're looking for higher levels within the pitchfork before we come back to the median line. It's often one of the two, and you can scale these things from grand supercycle, degree, supercycle, cycle, intermediate, primary, but so on and so forth, and they often project price very accurately. Timing's the issue, of course, but that's why we have our time cycles and stuff that we've projected for the long term. You can go and watch that video. So as you can see here, we have our cycle wave 2 correction into the lows of December 18. We then have wave 1 at intermediate degree to the median line, back to the outer band into COVID, 3 through the median line, 4 back to it, 5 into completion around the 61.8, the golden zone. This completes primary wave 1. We come back to the median line for the first part of the correction, hang around it for a while, and then we flush down through the 38.2 for support, through the 61.8 for resistance on the way back, down through the outer band, and actually break it. So it's quite bearish here, these lows were. And this completes primary 2. So we've had cycle 2, primary 2. Everything since the low in November 22, in my count at least. You may disagree, but in my count, we are now in primary wave 3. Primary wave 3 of cycle wave 3 of super cycle wave 3. So we're in the biggest, longest, stretchiest, most powerful, what should elicit the greatest support, the greatest involvement, the greatest inclusion and growth and engagement period of the asset itself, right? That's where we should be getting. I mean, I think psychologically, fundamentally we're there. You know, we've got the President of the United States basically on board. We've got talk of Bitcoin reserves. We've got Wall Street on board. It feels very much like a free. The primary 3 of the 3 should have this maximum growth, maximum involvement aspect going on, and I'd say we've got it. Okay, but that's just my opinion, man. You know, you can disagree. So here we are now going off into primary wave 3. So for what we can do here, you can see how we've moved up to the golden zone, down through it eventually, back through it again, up onto the 38.2, now using that as support. We can use a more filled out version of this, but it gets a bit messy. We also have another pitchfork here, which we can apply the exact same methodology, but to the next wave degree down. This is primary wave degree down. So as you can see, this has been trundling along the bottom of this pitchfork, where we've come up to the 61.8, the golden zone, back to the outer bound, through the 61.8, back to the outer bound, up to the 61.8, and back again. And we haven't quite made it to the median line yet. We're still some ways off. But that's the most likely target we're going to be drawn towards at this wave degree within this larger pitchfork as well. So just wanted to share that piece of geometry with you. I think it's just has an interesting look. Now why am I doing that? Well, there's this line on the chart here called invalidation. This is the top of the primary wave 1. Simple rule in Elliott wave is the wave 4 of the same wave degree cannot come back through the price territory of the wave 1 of that degree. So we're all in primary degree now. So whenever we complete primary 3, wherever we complete it, we can't bring 4 back for that 1. We just can't do it. So if we are now looking to complete primary 3 within the next few months, When it's done, the next big bear market, which I think will be primary wave 4, cannot come back through 69,000. Okay? If it does, for any reason, come through 69,000 before we complete that primary wave 3, then this count and how we've interpreted it is not, the primary count is not the correct count. There's something else going on, and we'll talk about that in a moment. But those are my projections. So in the shorter term, this is how I'm interpreting it. From the lows of November 2022, there are two ways of looking at it. My primary is that we've done 1, 2, 1, 2. Why would I choose this over the alternative? Although I believe the alternative is completely valid. I choose this because it buys us a lot more time and a lot more waves to get this completed primary 3 high enough so that the 4 has space to correct. The more wave degrees we have left, the higher we can push this 3. So if we go 1 and 2, 1 and 2, we can now go potentially 1 and 2, 3 and 4 and 5, 3 and 4 and 5, and we can get further and further along. We could even potentially go 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, and push this higher that way. Either way, it buys us more wave degrees left, more corrections left, more time to get this price higher before the end of the bull market. So that 4, the big next bear market I'm projecting, has room to correct. Okay, alternative is this. We've done 1 and 2 at intermediate degree, 3 and 4 at intermediate degree. We've done 1 and 2, 3 and 4 at minor degree, and we have one wave left to get all of that work done. So this would be nuts. This would be wild, because there's not going to be anything other than short-term corrections in it. This is going to rock it up, but it has to. In this scenario, I don't envision the bull market lasting as long as I'd expect it to, because I just don't think there's enough time left. If we're going to stick to the 4-year cycle, we don't have to. Cycles are there to be broken, but it's been extremely persistent and reliable and consistent since Bitcoin's inception. So we don't throw it out of the equation until it's proven wrong. It's still right for the moment. So this idea of 1, 2, 3, 4, this means that we've got to get a lot of work done in a very short period of time. Okay, although it would likely be a short period of time, I mean, is what I'm saying. It would have to be so volatile. And it just doesn't give us enough time, in my opinion. It's a solid alternate, but it's not my primary. My primary is this. 1, 2, 1, 2. This buys us more time to get this wave 3 further along in both time frame and price. And that's the only thing that's separating them. I'm not saying the other one's wrong. I'm just saying that's my preference. There is one final alternate idea as to why we might come back for the 69,000 level, and that's because we're doing something completely different. We're doing this instead. This is the most bearish idea I can come up with. We've had 1, 2, 3, 4 and 5 already complete. We're done. Now if that's the case, we will now collapse down into another bear market. And this bear market would be another wave 2. And this would bring us all the way back through that 69 level. And in my opinion, the long-term support, which sticks out just clear as a bell. If I can find the... I did have a... Is that... Oh, it's on my BLX chart. Sorry, it's on my Bitcoin Liquid Index chart. There you go. That's the level I think we'd come to. That makes the most sense in this idea. If we were to run up a fib from here to the top, right, there's the golden zone right on that line. 61.865. It's highly likely we come back to there, I reckon. That's in log, by the way. It's between the 78.6 and the 89 in linear, so it's a deep retracement. Deep retracement. Another wave 2. Not my preferred scenario at all, but it is a possibility, okay? So we just have to be aware of that. So to sum up, before we focus in on this little area, the short-term time frame, let's just go through them again. We are in primary wave 3. That's my assumption. If we're in primary wave 3, we could be doing it like this. 1, 2, 1, 2, and now we progress higher. We could be doing it like this. 1, 2, 3, 4, and now we progress higher, but we're in the 5th and final wave of that move. And if neither of those are correct, then we are doing another wave 1 into a yet another wave 2. We've done super cycle, primary, and now we'll do intermediate. Okay, and this would be a much deeper correction. However, this one would break the 4-year cycle, the one which has been consistently reliable since Bitcoin's inception. So this has got to be lower probability. Right, so there you go, there's my longer term counts. Now let's come in and have a look at the shorter term, shall we? So we're going to zoom in now of everything from the lows of August 24 into this high here. So going on simple count 1, which is the primary idea that we completed minor 1 into minor 2 back into August 24, how can we interpret this move up? We can do it like this. We're going to come down to the 8 hour here. We've had minute wave 1, minute wave 2, minute wave 3, minute wave 4, and now we're pushing off into what will likely be a more extended minute wave 5. And we've done 1 into 2 at subminuet at minuet degree, and 1 into 2 at subminuet degree. So we'll have to zoom in again, I think, here. Let's come down to the 1 hour and get a look at what's going on over here. So off of the recent lows of the January, 13th of January low, we came up into a wave 1. We came A, B, C into W, X wave triangle, A, B, C into Y, and then we've come up in 5 again. 1, 2, 1, 2, 3, 4, 3, 4, 5, 1. We've corrected sideways into 2. I have no idea what this is. W, X, Y, X, Z. I guess you could have to label it a triple zigzag. Let's just throw something in there. So here, bum, 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 flat, bum, 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 zigzag, bum, 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 zigzag, bum, 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 zigzag. There we go. Something like that. But it's clearly corrective, right? We've then come out again into another 1, into another 2. So what we can do, we can add a little bit more information onto the chart. We can go 1 and 2. Now, when we get down to these smaller time frames, and they are small time frames now, the likelihood of us being correct, exactly correct, drops. Okay, because the volatility in the price action and the general ugliness of these moves is much more difficult to interpret over shorter time frames than it is longer term time frames. Why my preference is to not waste too much time on it. Right, so if this is the case, we have a series of invalidation points we need to recognise. The closest one is 94091, which is only a few % away as I speak to you. What is that? 308 basis points, something like that. So it's just a fraction away. So a very tight stop for an asset like Bitcoin. The next one is a bit further away at 91530, sorry, that's 5.79% away. So what this does is subminuet degree invalidates at 94091. Minuet degree 1 into 2 invalidates at 91530, and the assumed low for minute wave 4 invalidates at 89164. If all these break, this is wrong. Flat out wrong, all the way back to minute wave degree, so we would just delete it at this point and we'd adopt an alternative. So there you go, that's the first short time frame count that I'm observing, and for the meantime that is my primary count within a primary count. Let's move on to the next one. This is the idea that we've actually got a smaller wave degree, 1, 2, 3, 4, 5, into a minute wave 1 high. So we've still gone 1, 2 back here at minor degree, but instead of going 1, 2, 3, 4, we've just gone 5 into 1 into 2 again. If this is the case, I'd expect it to be deeper. Okay, my target zone for the 50 to 61.8% retracement. Remember, this is based on if all these invalidation levels break. If all these invalidation levels break in the primary, we'll adopt this one first. Okay, we'll adopt this idea first because it's the closest next target we have. Brings us to the 50 to 61.8, or maybe deeper, because a wave 2 could come back 78.6 or 89. My suspicion is that we'll come back into all of this structure here. Right, this is all obvious structure for us to find a low into. Right, let's just bring up our visual range volume profile. So all this noise here, these are all this prior resistance becoming support. Highs, 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 highs is resistance becoming support. That's going to be around the 50 to the 78.6 region. If this is a wave 2 correction, let's just put that in. And you can see how coming back into here would also bring us back into the base channel. Bring us into all this support. 70 odd K region, right? It makes sense. This would allow us to come back through the 70 odd K region, 69 all-time high even of the prior cycle, right, and still progress higher. So this is deeper. Now the way I've interpreted it so far is that this is wave A down, B back into target as an expansive new price extreme, and then we come down in 5 waves in the C. There is also this one, and this slots into a different larger wave count. So we're going to come up to simple count 2. Remember, we had either 1 and 2 back here or 3 and 4 back here. This is the idea of the alternate longer term count of 3 and 4. This is 5 waves up again, but instead of 1 at a smaller degree being here, it's over here. So we've gone 1, 2, 3, 4, 5. Very brief, very short 5. Now we get a deep wave 2 retracement, very similar to the other count within the larger time frame count. So it doesn't really matter really at all which one we're looking at. We're coming back into the same target area, right? All this prior resistance, all this prior support becoming resistance. Big volume node here, this brief area right before it, and this null zone here are going to be interesting to see how price behaves if it comes back into here. But this is likely where we're going to stop. If we started selling off violently towards the direction of all this support here, we would be very oversold on the daily time frame by the time we got here. That would be a very likely area to find support. And this goes 3 into 4, 1 into 2, 3, 4, and 5. This buys us a bit more time in that secondary count to get that primary wave 3 high for the end of the bull market. It's still going to be brief. You know, it's not, in my mind, it's still not enough time, but it could be. It's better than just assuming we're already on our way. Okay. But there you go. So there you go, guys. They are the shorter term counts. So let's just talk you through them again, because I know that there's a lot to cover. It sounds complicated. It really isn't. There's only really 2 options over the long term and 3 options over the short term. So first things first. 1, 2, 3, 4, done. At the target zone of between 23.6 and 38.2, minute degree 4. We've now done 1 and 2 again. We will now move higher from here. Okay, we'll carry on high until we get minute wave 5 complete, at which point that would be minor 3. We'll then move back into minor 4, so on and so forth, and progress the count higher over the coming months as the bull market continues. If for whatever reason this count breaks down through 9409, 94530, 89164, then this is wrong. If this is wrong on the shorter time frame, the first thing we move to is this idea. 1, so it's the same idea again. Okay, that we're still in minor wave 3, but what we've done is topped in minute 1. We go A, B, C back for a flat pattern to target, back into the price support, and then we carry on progressing once again within minor wave 3. This opens up the possibility also of this count. I would expect this to be even deeper and more aggressive, and to come down a little further, and to have and it won't be a flat because we're starting from here rather than here. This would most likely be a zigzag or a multiple zigzag coming down. This changes the count though to the alternate longer term count of 3 and 4 back here, and this now goes 1 to minor degree, and that's it, guys. So really, if I wanted to sum up and say stop worrying about all of the things I just said, just focus on this one count first and these invalidation points: 94091, 91530, 89164. If we break these, then we can come back, and I will come back with another video, and I'll say, right, we've adopted this alternate count, and we're now putting that as a primary and the other count as our alternate, and we're back to having 2 counts. Okay, if we progress fine from here and off to new all-time highs, we just stick with this, and I'll come back and update you as and when I feel it needs to be done. So there you go. We've covered the long-term counts. We've covered the short-term counts. We've covered the bearish option of this being a 1. If this is the case, we're going to collapse all the way down to 30k or something like that. You know, it's possible. I don't think it's likely, but it is possible. My preference is that we continue higher from here. Okay, so now let's wrap up with some classical analysis, shall we, before we go? See what we can see here. Okay, so back out on the day time frame, let's bring up our exponential moving averages first. Okay, so on the daily time frame, we are currently trading above the below the 10, the 20 and the 60 exponential moving averages. The 10 and the 20 have come back to the 60, suggesting that this was a larger wave degree correction and we've been consolidating for longer. We are still holding below that 60 exponential moving average level. We'd like to see a move above that, bring the 10 and the 20 back into pointing upwards. bringing the 60 with it and resuming the upward trend. 250 still pointing upwards and progressing as an upward trend. Long-term support still intact. Long-term upward trend still intact. If we come out to the weekly time frame, have a look at our moving averages, we can see the 10 and the 20 and 60, 250 all still pointing up. The last larger wave degree correction we had on the weekly time frame was back here into the lows of August 24. This is when we tested the 60 exponential moving average, and the larger wave degree correction above this wave degree was back when we went through the 250 weekly exponential moving average all the way back here into November 22, the last big bear market. I would expect again the next bear market, when it comes and we complete that primary wave 3 into primary 4, we will once again be testing at least the 250 exponential moving average again. It seems to be very normal behavior for a larger wave degree correction. Shorter wave degree corrections tend to test the 60, and then larger wave ones tend to test the 250 on the weekly. So that's, as you can see, we're a long way above it. We will one day come back to it, but by then it will be a lot higher. So yeah, that's how things look with our moving averages. Let's have a look on our indicators here. So on the weekly time frame, we can see how momentum from high to high, this high back here on the histogram to these highs here on the histogram to these highs here on the histogram, we continue to expand. Momentum is growing greater with each move up. So this is stronger than this, and this is stronger than this, and each of the average and signal lines continue to progress to higher highs. Same is being registered here on the OBV, series of higher highs and higher lows. And then if we look at the RSI, we have, for the meantime, on the weekly time frame, after coming back to neutral from this high, we do have divergent highs here. The time frame this is on, though, and unsupported by both the MACD and the OBV, suggests that the actual RSI was reset with its move to neutral, and we should only really be observing the shorter term divergences building up now. So what do I mean by that? Let's come in and have a quick look. Now we go from close to close on the RSI. The close here of the week of the 16th of December 24 is higher than the closes since. Although we've had an intra-week high, we are not on a close basis higher, and therefore this is not bearish divergence. Okay, even though it's not present here on the OBV anyway, but it is present on the RSI and it is present on the MACD. This is not bearish divergence. If you measure from intraday to intra-week to intra-week and say higher high, higher high, lower high, that would be, but that's not how the RSI here is calculated on the closing basis. So is the MACD on the closing basis, right? And therefore we measure from close to close, and on that basis this is not divergent highs. Okay, now on the daily time frame we can come down and see if it is. On the daily time frame we can take the close and we can see once again the closes are the same. If not, in fact, the close here is ever so slightly below this one. So we can see we had bearish divergence building into these highs on both the MACD and on the RSI, and then we had a correction into neutral. We've had a move back to overbought, and then we've had another correction into neutral, but not oversold conditions. Whip soaring on the MACD around the zero bound, bearish momentum on the shorter time frame starting to die off, average ready to cross through the signal line but hasn't done it yet. So this also was not bearish divergence, okay, because we calculate it on the closing basis. Now let's move out to the monthly time frame, shall we, and see what we can see. On the monthly time frame we have momentum continuing to expand as the average lines move and signal lines move higher. The OBV continues to track higher highs and higher lows. However, there is monthly divergence at the moment present between prior highs and the current highs at this move here to this move here. Now this is not yet divergence. This is divergence between current highs and previous price, right? This is not divergent high in place. We do not have a monthly pivot in place up here, right? If this was a big bearish monthly engulfing candle which gobbled up these two prior months and collapsed, right, we could say there's a pivot in place here, but there isn't. We're still well within the prior month's action and within the prior month's action of that as well. So we don't have a bearish pivot up here, and it's not supported by divergence on the OBV, and it's not supported by divergence on the MACD, which are both thrusting with greater momentum higher. Normally these both slacken off into the high. So can we look back? Yeah, let's just look back at these two closing. These are close to close, right? There's monthly close. This is 21, 22 bull market, right? If we come back and have a look, we had monthly divergence here into the high. If we look at the RSI, we had monthly divergence into the high. If we look at the OBV, we had monthly divergence into the high. No such thing present yet. Okay? There's monthly divergence on the RSI, but it's only present on the RSI. It's not present on the OBV. It's not present on the MACD. And this can disappear quite easily with another thrust higher. So it's just the RSI showing some temporary divergence, which may turn into actually confirmed divergence, but it isn't yet. If it were to, it's not supported by the OBV, and it's not supported by the MACD, whereas prior cycles have been. We've weakened into those highs collectively. So for the meantime, bull market is getting longer in the tooth, right? There's no doubt about that. We are 3 years and a bit through the 4-year cycle. We've got, by my reckoning, between September and November this year before it's all over. Right, so you might say, oh, that's loads of time. Out of 4 years, it's really not that much time. We've done the vast majority of the work now. So we're on to our... Well, it's not fair to say 4 years, is it? Because it's a 3-year bull market, 1 year bear market. So out of the 3 years going up, we've done most of the work, okay? We've got about 9 months or so left. And then we'll peak. So we'll see what happens with this divergence on the monthly time frame. But like I said, the weekly time frame, between closes, there's no divergence at the highs here, and there isn't between the prior peaks. And on the daily time frame, same gig. We had that divergence where there was bearish divergence between highs, okay, on a closing basis. This did prove to be the beginning of a correction. We've since corrected and come lower. We haven't come down to oversold conditions, right? So there is potential. How would I okay, trying to explain it fairly, because I don't want to take it away from the bears who've got a point here, which is we are weaker. Let's put it like that. We're weaker into these highs. We've lost momentum. We've weakened into these highs. We haven't shown classic bearish divergence from closing basis, but we are weaker here. So the arguments that we could break down back to that 70,000 level, which I've suggested in 2 possible counts, is a very viable idea. But I don't choose a bearish count while we're still in an upward trend of higher highs and higher lows. We're in an upward trend of higher highs and higher lows, and while that trend holds, we stick with it. Once it breaks, we can adopt a more bearish stance. Okay? Right then, guys, I'm going to leave it there. Thank you very much for joining me. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you want to learn Elliott Wave for yourself, of which there's a course available, a series available on my Patreon, and you want to learn how to do all this technical analysis stuff, you want to get access to a public Discord with loads of members on multiple channels discussing lots of ideas and sharing ideas all the time, you want to get access to live streams, weekly exclusive material, loads of other educational material, as well as my Bitcoin price projections for this cycle and a bunch of other stuff, feel free to sign up to the Patreon. It's just 10 quid a month, and you can leave after your first month if you want. So I think it's a bloody good price for what you get at the end of the day. But either way, that's up to you. Feel free to sign up if you want to. Link in the description box below. And take care of yourselves, guys. I'll be back with you as soon as I can. All the best. Bye-bye.